Okay, Chapter 5, Part 2. First, I want to look at problem number 22, which I think is one that you guys are always doing, are also doing. So your problem will probably look just like this and just have different numbers. Okay, so Matthew borrows $250,000 to invest in bonds. During the current year, his interest on the loan is $30,000. Matthew's taxable interest income from the bonds is $10,000. This is his only investment income. We want to first know what Matthew's itemized deduction for investment interest expense for the year is. So let's talk about that first. So he had interest expense of $30,000, but he doesn't get to deduct all of that. The amount of interest that he can deduct for these purposes here is limited to the amount of his interest income. So if he only made $10,000, that's all he gets to deduct. He doesn't get to make $10,000 and then deduct $20,000. So his itemized deduction is $10,000. And then what happens to the rest of that? So he has $20,000 of interest expense that he doesn't get to deduct during this year, but he does get to carry it forward. Is he entitled to a deduction in future years? And the answer is yes. So if there's any amount that is not able to be used in one year, it gets to be carried forward to future years. So next, maybe it takes him 5 years to use it up, but it does continue to get carried forward. Okay, now let's take a look at problem number 24. Okay, and this one's kind of interesting because if you're someone that was doing tax stuff or learned tax stuff in previous tax years, there's something in this type of a problem that has changed. One of the things that can be both interesting and also extremely frustrating about working with tax is that you can spend countless hours and lots of energy learning and trying to understand all the tax laws. And then guess what happens? As soon as you think that you have a pretty good grasp of everything and you kind of have all those numbers stuck in your head and you know what standard deductions are and you know how every item is being treated, then we have a president like Trump that comes in and passes a bill to greatly change the tax rules. This tax bill that the Republicans recently passed made enormous changes to the tax code and the treatment of things. So keep that in mind. People who do taxes typically make good money because of that, because they have to keep up on constantly changing things. So if it fits your type of personality, then certainly go for it, because a lot of people just don't like tax, and a lot of people are afraid of tax as well. So, okay, with that said, let's read this problem. Janet and James purchased their personal residence 15 years ago for $300,000. During the current year, they have an $80,000 first mortgage on their home. So what is a first mortgage? First mortgage just means that was the mortgage that was used for the original purchase of the home. It wasn't money that was borrowed at a later point, on which they paid $5,750 in interest. They also have a home equity loan to pay for the children's college tuition, secured by their home with a balance throughout the year of $150,000. And they paid interest on the home equity loan of $9,000 for the year. So we want to know what is the amount of their deduction for interest paid for both qualified residence acquisition debt and then qualified home equity debt interest. So first of all, for the qualified residence acquisition debt interest, that amount is going to be the full $5,750, because they're still very far away from the limits that are imposed on the amount of interest that can be deducted for a primary residence, and all that you read in section 5.8, which is a pretty interesting section to read. Additionally, okay, here's what's interesting. In Part B, how much of that $9,000 in interest do they get to deduct in 2018? And the answer is nothing. So this might seem surprising to you if you did studying before on tax, because interest on home equity loans previously was deductible up to a limit of $100,000, and there were some other requirements that had to be met. But now what's happened is, and I'll point it out to you in your book, if you go to page 5-30, at the top of 5-30, they talk about the term qualified residence acquisition debt is defined as debt secured by the taxpayer's principal or second residence incurred in acquiring, which is purchasing, constructing, building it, or substantially improving that residence. So that would be something like remodeling the bathroom, remodeling the kitchen, putting a new roof on, stuff like that. So since this home equity loan is to pay for children's college tuition, it does not qualify as residence interest that gets to be deductible. So unfortunately, the answer is zero. So that deduction for interest for a second mortgage for anything other than, again, acquiring, constructing, or substantially improving, remodeling a house, that interest deduction has been suspended until the year 2025. So I think that it's likely that it could change sometime in the future. It really just depends on who's in office. Do we have a Democrat-controlled House and Senate and President, or do we have Republicans in there? So you can see that when this tax law was passed, it was passed by Republicans. So if Democrats get back into power, then I would expect something like this to change. So it's really interesting to follow things like tax rules and just law in general to see what a Republican's doing versus what Democrats are doing. And that should be what should aid you in your decision making as far as who you're going to vote for, not just for president, but for all these other offices. They have an extreme amount of power, these legislators, and a lot of people don't vote, and a lot of people are very uneducated about what these people are actually doing and how much power they actually have. So I definitely encourage you to be an active participant and educate yourself on what's going on in this country, particularly at this point in time, because it's really quite disturbing. Okay, let's look at one more problem. Okay, here's another one. This one is on casualty and theft losses. This is problem number 31. So in January, Carrie discovers her diamond bracelet has been stolen. The bracelet had a fair market value and adjusted basis of $7,500. Oh my gosh, that is so much money to spend on a bracelet. That's insane. Okay, assuming Carrie had no insurance coverage on the bracelet, which that was her first mistake. If you're going to wear $7,500 worth of stuff on your wrist, then you need to have insurance, because the government doesn't care and they're not going to help you in this sort of a case. And the adjusted gross income for 2018 is $45,000. What is the amount of money that he gets to deduct for casualty and theft? The amount is zero. And it is zero because only personal casualty and theft losses associated with federally declared disasters are deductible. Everything else is not. So the IRS is basically saying to us, this is not our problem. You should have bought insurance. Okay. That's it. That's all the videos I'm going to do for chapter 5. So I hope you've enjoyed this chapter. Like I said, it's my favorite.